At $40,000, and this is the average interest rate on that on those credit cards. But it will take him well over 30 years to be able to pay off this credit card debt. He will end up paying somewhere around 385,000. As long as you have a yes to self-employed income and no to the fact that you have any full-time employees, you actually have the ability to own your own retirement. I can create an empty checkbook controlled 401k for you. He gets to set the interest rate. He gets to set the timing as to which he pays this back. But ultimately, he has control. And the biggest piece here is he has control over what this looks like. So there are many items that we talk about, right? And our objective today is kind of merge is the objective today is to merge how to leverage a self-directed retirement account like a self-directed 401k and be able to take action in these other spaces to accomplish your goal. Meaning we're going to use or leverage dollars here to also do velocity banking. And to your point, sweetheart, most people don't either understand that it's possible or are adamant that it can't be done without being taxed and penalized. So my objective today is to kind of walk through how it can happen, how it can be done, and you will not be taxed or penalized if you, again, structured properly and you understand how to use dollars in this fashion. So to kind of dig into the details, this is kind of how it started. Um, it was, hey, I've got debt and I've got a lot of debt. And well, let me start here. It all starts with what are your numbers? And so what it started with, hey, I've got 225,000 on a mortgage, $40,000 in credit card debt, and I've got 3 vehicles that I'd like to get rid of. And so, hey, I've been watching your videos on velocity banking, and I like to use velocity banking to be able to get rid of some of this debt. So his objective was, hey, can you help me identify a debt tool to be able to eliminate this debt quickly? And then when you kind of dig into what that means, he's got $40,000 in credit card debt at $40,000, and this is the average interest rate on those credit cards. But that $40,000, if he continues down the path that he's on, meaning just simply making the payments as they've been requested, it will take him well over 30 years to be able to pay off this credit card debt, and he will end up paying somewhere around 385,000. And I share this slide mainly because how many of us are in a similar position? Meaning we've got credit card debt, and if we don't address it timely, we don't really realize how it's snowballing, how it's getting bigger. So just wanted to highlight what this dollar amount looks like over time if we don't really take some drastic action. And it doesn't always have to be velocity banking, but no action means we're paying fairly large amount more than is probably deserved. And when you dig into the details of Michael's portfolio, or his numbers. His income makes about $6,000 a year. He's got expenses in total of about 5,000. Again, that total debt, that $3,000, the mortgage plus the cars is kind of the debts that's hanging out. And his cash flow is somewhere between 500 and $1,000. And as we talk often, if you pay any attention to what we do on this channel, a lot of the examples we use, the cash flow is usually right around this same area. And it's because most of us, after we pay our bills, most of us, if our lifestyle changes and our income changes, 9 times out of 10, our bills will change as well. And what that ends up meaning is that cash flow ends up being somewhere right around that same space, somewhere between 500 and $1,000 a month. And what options does he have? So I go back to peeling the layers back and better understanding what's available for Michael. And here's what we learned. He's got a previous employer plan. And that previous employer's plan is currently sitting I think it was sitting in Fidelity. He no longer works for the company that 401k was previously with. And he's at a brand new company. He never really understood how to leverage, how to use it. It was just sitting there. So we had a few different conversations about the dollar amount sitting here. It was, hey, there's an annuity option. There's a few different options that he could actually use. But his thought was, hey, I do have this side hustle. I do have this business that I have has its own LLC. Is it possible that I could move that 401k, those 401k dollars or into a new self-directed 401k, merge with his side hustle, merge with his business, and then in addition, we want to ultimately leverage all the benefits and promos of velocity banking. Taking what taking what he makes and getting multiple uses out of the same dollar, and ultimately watching his overall portfolio, his overall credit worthiness, his overall credit score increase in the process.
It's a really great point that it doesn't show up on your DTI because there's a lot of people who
Caught
are
that, did you?
trying to get, yeah, well, let's just
Mhm.
for a second, there's a lot of people who are trying to qualify for PLOCs or HELOCs. And the other, I'm going to say something else than what I was going to actually say. Okay.
Self-censoring. We're good at that.
It's predatory. It is. It's an HEA, and this sounds like a HELOC. It the influencers who are doing all of this like user generated content out there, they're trying to make it sound like it's a HELOC or a PLOC, but it's really not. However, because a lot of people are riddled in debt right now, or they are trying to find ways of jumping in and finding where's a significant amount of leverage that I can use for a velocity banking strategy to rapidly reduce my debt, right?
Right.
And save on interest. They're open to looking at these types of tools, but an HEA is something that people are going towards because of the DTI limitations, based on how much their debt is.
Right. Ultimately, it doesn't show. Right. So,
Yeah.
with a self-directed retirement account, this is think of it actually to not overcomplicate this. If you've ever had a retirement account with the company that you work for, in most cases, you are able to leverage it, borrow against it, use it for a certain portion. There's a certain dollar amount that they won't allow you to exceed.
Mm-hmm.
And in addition, they're going to charge you or force you to pay it back. It's going to be direct debited from your income, and you have zero control over what that interest rate or the timing in which it has to be paid back. So there's limitations, but ultimately, what we're referencing is still a similar vehicle, meaning it's the same loan, same leverage that you're able to use with any retirement account. What we're talking about.
Okay.
So, and as it relates to a self-directed 401k, and again, I'm jumping right in. We are not talking about what is a 401k, we're jumping right in. When it comes to having your own retirement account, when it comes to creating your own 401k, there are two main factors that we have to look at. One, if you have a business, do you have any full-time employees? And if the answer is no, and in addition to that, if you have a business, that means you ultimately have self-employed income. So as long as you have a yes to self-employed income and no to the fact that you have any full-time employees, you actually have the ability to own your own retirement account. It is really just this simple. And based off those two factors, I can create an empty checkbook controlled 401k for you. But in order to do that, there has to be a sponsor. All 401ks require a sponsor. And if you think about it, your current retirement account with your current employer or a previous employer that you've ever had, someone had to sponsor that retirement account, that 403B, that TSP, that government 457 plan, that 401A, that 401k. Someone had to sponsor it. Who was it? It was the company that you work for. So if you have your own self-employment income, if you drive Uber, if you do rideshare, if you belong to some MLM and you're under someone's pyramid, whatever. I was going to say some other things myself, but I won't. But the bottom line is, if you have self-employed income, that is enough to have a business, or that is a business. And if you have an LLC, an S corp, or C corp, those are viable entities that will allow you to own your own 401k. Meaning, those are the sponsors of that 401k. And once you have that sponsor, I'm in a position to then create a self-directed 401k for you. So what does that look like? Okay, you've got this previous employer's plan, Michael in this case, sitting at Fidelity. What I'm going to do is I'm going to create a brand new self-directed 401k connected to a checking account with $0 in it, meaning it's empty. And what you will then do is go to Fidelity, click on your account, go to withdrawals. It will ask you if you want to take a cash withdrawal, a rollover, or a transfer. It gives you three options. You want to choose either the rollover or the transfer. It's going to ask for the banking routing number of the institution that's going to, the name of the institution, which I would provide to you. And then you're able to transfer all of the money from that previous employer's plan into your own self directed 401k. And the structure that I provide to you gives you full checkbook control over every dollar in it. And in this case, Michael had, what was it, $40,000 sitting in his previous employer's plan. So what we ended up doing was, well, again, he's 35 years of age. So fairly young, fairly fresh 401k. He was at that company, I want to say 8 years before he left and went on to do bigger and better things. He's got about $40,000 sitting in a 401k ready to be moved. And so that's what we did. And just to kind of also highlight the power of having your own self-directed 401k, for those of you who are contributing to a retirement account, there's a certain dollar amount that you're able to contribute. I just want to make sure this is clear. What's so powerful about a 401k are the contribution limits. Based off your age, you're able to put in an additional $23,000 if you're under the age of 50, plus profit sharing, meaning plus the match. And that matches for an additional 25% of your income up to 46,000. So 23,000 plus 46,000 if you're under 50, and if you're over 50, there's 30,500 plus an additional 46. So if you have your own retirement account, if you have your own 401k, and you have a business that is producing a significant amount of income for you, or even not necessarily a significant, if you're looking for a way to be able to reduce your taxable income, this is a viable option. Meaning, it allows you to reduce your taxable income by being able to contribute to this vehicle. In addition, a match. And so that was kind of ultimately what we kind of talked through with Michael. And the biggest piece was this: in addition, 401ks have some other benefits. One of the largest, one of the most impactful benefits of having your own self-directed 401k is your ability to borrow against it. Your ability to leverage the money in that 401k to be able to be used for whatever it wants. And what does that leverage look like? Look like? It looks like 50% of what's in it, you're able to borrow up to $50,000. Well, in Michael's case, he's got, what was it, 40K? So he has the ability to leverage 50% of what's in it, which would be $20,000, leverage that $20,000. And when he does that, he gets to set the terms. He gets to set the interest rate. He gets to set the timing as to which he pays this back. It does have to be done in equal increments, but he is the one that determines when that is. And again, he also sets the interest rate, meaning if he wants to charge himself prime plus 1 or 2, he can. If he wants to charge himself a little bit less than prime, a little bit more than prime, he has the option. Now, I call it, there's guardrails that you want to stay between, but ultimately he has control. And the biggest piece here is he has control over what this looks like. And because he has control, it allows him to take action that otherwise he would not be able to do if this money was still sitting at Fidelity or sitting with his previous employer. Sweetheart, did you have a question or anything?
Yep. Does having a rental property qualify as having a business if I open an LLC?
So real estate is a little bit tricky. There is being in the business of real estate, and then there is having a business that does, I'll call it fix and flips, or has a couple of rental properties and and is receiving some type of rent from a renter. So there's a difference between the two, and how you are structured makes a difference. But ultimately, if you have a LLC and it is a business that produces earned income, so the question is, how do you pay your taxes? If that LLC that you have and the rent that's being paid for that rental property that you have, if it's coming to you and you're paying taxes on it as income for your business, then yes, you absolutely, then yes, that does count. If you are in the business of real estate, there's just other rules or different rules you have to be aware of. So that's the reason I throw that out. But ultimately, yeah.